ladies and gentlemen, and welcome to today on the accounting principles of business combination transactions for tax practitioners. My name is Karen van Wyk, and with me I have Anton. Anton, welcome to today's webinar, and thanks in advance for your contribution.
Good afternoon, everyone. Thank you for joining us.
Thanks also to the South African Institute of Taxation for hosting us and making the platform available. Now, ladies and gentlemen, why are we here? Why is it important for a tax practitioner to talk about business combination transactions? And what is meant with business combinations? What does it mean, and how would we come across this in practice? Anton, can you maybe shed some light on the topic?
Karen, I think it's important that we look at what a business combination is firstly, all right, because there are different types of business combinations, and different types of transactions obviously impact differently on the tax practitioners. So you will find that there's especially one type of business combination transaction where assets and liabilities are acquired directly, that will impact more heavily on the understanding of the tax practitioner of what is happening, because assets and liabilities are actually being recognized. So it's not about, performing consolidations and preparing group statements and those types of things, but it's actual acquisitions of assets and liabilities. And why I think it's so important is because the concept of a business combination transaction actually provides the acquirer with a clean slate, because what the attendees will see this afternoon is that there are sometimes some assets and liabilities that are more easily recognized in a business combination transaction that would have not been recognized in other types of transactions. And we need to understand the background for this, because effectively we are paying an amount of money to acquire assets and liabilities, all right? And the difference between the value that we obtain and the purchase price that we pay is obviously going to end up as goodwill when we have business combination transactions. Right. So what's important is that we need to understand that assets and liabilities are then recognized to a large extent as far as possible to replace the goodwill. And that is why whether you're dealing with IFRS 3 in full IFRS, or whether you're dealing with the IFRS for SMEs, the same principle is applied, and that is to try and allow more actual assets and liabilities to be recognized in business combination transactions, because if you don't do that, you're going to end up with a lump sum called goodwill or negative goodwill that we can talk about in a while. So, just to bring it back to why it's important for the tax practitioner, that is obviously to make sure that the practitioners understand where these assets and liabilities come from that they might not recognize in financial statements where business combinations did not take place. So these are types of unique assets and liabilities that sometimes get recognized in business combination transactions.
So if we look at the concept at face value, business combinations, that would mean combining businesses into one. But I'm sure that there's more technical detail associated with when something constitutes a business combination. Can you maybe share with us what that consists of and what the requirements are for it to be a business combination?
I can definitely try. The definition is quite simple. What is a business combination? It is the bringing together of separate entities or businesses. So what we need to understand is we already in the definition see that there are two main types of business combination transactions. We either bringing together separate entities. So this is your typical situation where one entity acquires an equity stake in another entity and obtains control in that way. All right. So that's a parent subsidiary type of relationship. And then the business combination is when you bring those entities together, or the bringing together of businesses. So you can also acquire a group of assets and liabilities functioning together as a business. So that means you're not acquiring an equity stake in another company, you acquire their operations directly. So you acquire assets and liabilities. But because those assets and liabilities together function as a business, we need to deal with them in terms of IFRS 3 and the section in the IFRS for SMEs dealing with business combinations, which means that the measurement principles are different because we are initially measuring at fair value. And had this not been a business combination, I think the attendees will agree with me that assets and liabilities are most often, especially assets, are most often initially recognized at their cost price, not their fair values. And that is the big difference when you acquire, assets and liabilities in terms of a business combination. The fair value measurement concept is extremely important. Now, the next thing that's important is that in almost all business combinations, one entity which we call the acquirer, obtains control. So we acquire control over one or more other entities or businesses. Now remember, when you directly acquire assets, you also obtain control over that asset, because the definition of an asset is that it is an economic resource that is controlled by the entity. So even when you acquire an asset directly, you are obtaining control. So when you obtain control either over another entity or over a group of assets and liabilities that together function as a business, you are satisfying the definition of a business combination. Now, what you can see on the slide there, Karen, is that you can ask the question, how can a business combination be structured in different ways? We can purchase a controlling interest in the equity of another entity, right? And remember, when you're looking at control, we're talking about voting rights most often. Like a 60% investment doesn't automatically give you control because it exceeds 50%. We need to look at the voting rights attached to your interest. Secondly, the purchase of all of the net assets, meaning assets and liabilities of another entity. We can even have a business combination when we assume all of the liabilities of another entity. Think about a special purpose entity that is created where you move all of your liabilities into that particular entity. They assume the liabilities. That is a business combination transaction. Now remember, the moment you classify something as a business combination, you have to think that the measurement principle is going to be different, especially at initial recognition. And then lastly, the purchase of some of the net assets of another entity that form one or more businesses. So we can see there are different types of business combinations.
It'll be interesting to see, and as we unpack this in the session today, how the accounting is different dependent on the route that you've taken to construct this business combination, because I'm thinking that you'd be accounting for it differently depending on whether you've acquired the assets and liabilities or whether you've got a controlling interest, for example, an equity interest that you've acquired. So that's going to be interesting to see those differences.
That's correct. That's correct. Because we'll look at the accounting in a short while, and then you'll see, that we're not going to go into a great detail of consolidations today, but we're going to refer to what would lead to a consolidation versus what is an actual journal entry, which is an asset acquisition in terms of a business combination transaction, and the difference between the two. We've actually got two examples lined up here just to introduce this difference to the viewers.
All right, so the first example that you've brought, Anton, says a percentage equity stake is acquired. So in this example, it says SME ABC Pty Limited acquires 80% of the issued equity of DEF Pty Limited on the 1st of Jan 2023 for R1 million cash. So that sounds quite simple. The equity of DEF Pty Limited was as follows at that date. So the share capital of 100,000, retained earnings of 900,000, and the total equity fairly stated is R1 million. Now, how does that equate to what you've paid for the interest of R1 million, bearing in mind that that's an 80% interest in the business? And how do I account for this acquisition?
Now, Karen, this is our first example of where you acquire a controlling interest in another entity. So we can see here what is firstly very important is that you see total equity fairly stated Now remember, we're making that assumption for this example that your equity is fairly stated. Now you can never go and fairly state your equity. You look at assets and liabilities because remember, equity equals assets less liabilities. So you can only fairly state your equity by making sure that your assets and liabilities are fairly stated. And that will be a section that we're going to have a look at a bit later in this discussion. But if we assume that this entity's equity and therefore its assets and liabilities are fairly stated at R1 million, the value that we obtain is 800,000 Rand. What did we pay? We paid R1 million for an 80% interest. So we can see we paid R1 million, but the value that we're getting is 800,000. Now, if you look at the journal entry that ABC will be processing, they'll debit the investment, R1 million. That's the fair value of the consideration. Remember, the consideration that was given here is cash. So R1 million is the fair value of the consideration. Debit the investment, 1 million, credit bank, 1 million. So now the question is, we overpaid 200,000 Rand from a value point of view. Because remember, we're paying for things like obtaining control and synergy, and there are other strategic reasons that we are willing to overpay. But now the question is, where do we see this goodwill? Certainly now, if we say the value that we obtain is 800,000, where's the goodwill? The goodwill is embodied at this stage in the 1 million Rand investment. Remember, in that 1 million asset, debit investment at R1 million, there's 800,000 Rand value in the form of underlying assets and liabilities of the subsidiary. And there's 200,000 Rand overpayment that we call goodwill because we are able to justify that asset being recognized. And that's where the goodwill is. The moment we perform a consolidation and we bring the actual assets and liabilities of the subsidiary into the group statements, the investment is obviously eliminated, replaced by the 800,000 Rand assets and liabilities, and then the balancing figure of 200,000 Rand goodwill will be separately standing out in the statement of financial position at group consolidated level. Right.